Going further with the event, it is my distinct pleasure to introduce to you, ladies and gentlemen, our distinguished guest on the dais, Mr. M.R. Kumar. Mr. M.R. Kumar assumed the position of Chairperson of the Life Insurance Corporation of India on March 14, 2019. As a direct recruit officer, he joined LIC of India in 1983. In a career spanning more than 3.5 decades, he has had the privileged opportunity to manage 3 zones of LIC of India, namely Southern, North Central, Northern Zone, with respective headquarters in Chennai, Kanpur, and Delhi. He has a profound understanding of the country's demographics and insurance potential as a result of his vast experience across working in India in different zones and in different capacities and management fields. Additionally, Sir chairs the board of LIC of India's domestic and international subsidiaries, including LIC Housing Finance, LIC Mutual Fund, LIC Pension Fund, and LIC Card Services, as well as the joint ventures on foreign soils, including LIC Bahrain, LIC Lanka, LIC Nepal, and LIC Singapore. Sir is also a director on the board of Kenya-based insurance company, Ken India Insurance Company, which specializes both in life and non-life business. With this brief introduction, I request you, sir, to kindly come to the podium and present the special address. Ladies and gentlemen, please join me in welcoming.
Thank you. Good morning, everyone. Mr. Devashish Panda, Chairman IRDI, Mr. Saurabh Mishra, Joint Secretary DFS, both joining from VC, Director and the Chief of National Insurance Academy, Mr. Srinivasan, Mr. Devesh Srivastav, CMD of JC Re, colleagues, ladies and gentlemen. It gives me immense honor and pride to be part of this program. Let me congratulate Mr. Srinivasan and his team at NIA for creating this 18th Insurance Summit offline. It's been quite a while since we all met, really, and as we pass through the difficult times of COVID and post-COVID, I think it's time to get together physically and to really talk to each other and find out what we need to do. Over the years, the Insurance Summit has become a very vital platform and a sentinel of great importance for the insurance fraternity to come together and deliberate upon significant challenges faced by the industry and what we need to do to overcome them. Let me thank Mr. Devesh Srivastav ji for covering most of the non-life part of it. I'll stick to most of the life part of it, and there's nothing new really. Whatever we've been wanting to do over the last 3, 4, 5 years, nothing has changed. But we need to revisit the issues that we face. We need to revisit where have we gone wrong and in penetration, in coverage and things like that. So I'm going to take you through some of the key bullets, maybe 10 of them, which we keep revisiting whenever we meet. However, before that, let me also say that 18th Insurance Summit chiefly aims to draw attention towards the theme that you're seeing on the screen, broadening the horizon, navigating towards a fully insured India. This, of course, requires diversifying into new territories, business models, innovative products, and calls for expanding into channels of distribution beyond the traditional ones, leveraging the digital applications to create new customer experiences, therefore, and thereby creating trust, confidence, and satisfying their needs. Achieving a fully insured India will require all stakeholders coming together, collaborating on solution orientation that would help us to achieve multiple resilience goals at the same time, and much needed for a smoother and safer drive towards prosperity of an emerging economy. So as I said, for this purpose, I have considered certain important areas. I'll just take you through some of them. Again, let me say there's nothing new, but we are just revisiting those things that we need to keep revisiting. First and foremost, of top of the mind recall is insurance penetration. Mr. Devesh has already covered some of it. But if you take the 5-year period from 2017 to 2022, life insurance industry has grown at a CAGR of 11% in total premiums and 17% in new business premiums. It is estimated to grow at a CAGR of 9% until 2027, but I believe we can do much more. As per the Swiss Re report of 2021, India's life insurance penetration premium as a percentage of GDP is 3.2, and life insurance density premium per capita in USD is just 59 USD, which is comparatively much, much lower than other leading economies. Although the per capita income remains lower, the size and growth of India's working class, as Mr. Srivastava mentioned, remain one of the largest globally, presenting an enormous opportunity for life insurance companies to expand into. And within the Indian market, India ranks, of course, 10th in the global life insurance market, ahead of China at 2.4 and UK at 3%. Second bullet is about mortality protection gap, and this refers to the difference between people's life insurance cover and what they should be actually having. In India, it's very high, over 90%, widening further due to climate change, rising catastrophic and pandemic risks. The protection gap in life insurance and annuity business has been increasing. For instance, the mortality protection gap is currently over 93%, estimated to be US $16.5 trillion. And Swiss Re has estimated the Asia Pacific mortality protection gap as USD 83 trillion in 2019, of which 5 emerging economies account for USD 61 trillion. China has the highest overall mortality protection gap with its population size. Still, by household, families in India are more vulnerable to coping with the loss of their breadwinners financially. According to the latest Economic Survey 2021 published by the Ministry of Finance, only 3 people out of 100 have a life insurance policy in India. Though the life insurance penetration has improved substantially after the pandemic, from 2.8% in 2019 to 3.12 in 2021, still much more needs to be done to enhance insurance penetration among different sections of the population. Let me come to bullet number 3. This is again about the growing HNI market. In 2021, India experienced the highest growth in high net worth individuals globally. The population of high net worth individuals rose 10.5% in India to 3.08 lakh last year, only after the US. According to the Hurun India Wealth Report, there are $412,000 millionaire households, stroke affluent households in India with a net worth of at least rupees 7 crore. With an increasing consumer appetite for insurance products, insurers and wealth managers are attempting to keep pace with the growing interest of demanding investors. From a service delivery standpoint, the industry is slowly pivoting towards more customized services, digital contacts, real-time reporting, and filtered communication. All these are critical to the success of these companies. Insurers and wealth managers are today focused on transforming their client service model, shifting from wealth maximization to a more goal-based investment and protection approach, focusing on significant customer milestones, including marriage and retirement. Life insurers can certainly encash upon this shift by aligning their business model. And that was HNI. The fourth item is the growing low income and middle segment. And therefore, this is where the opportunity really lies, because opportunity is not limited to the HNIs. The emerging market exists at the other end of the spectrum. Although low income households comprise India's most significant consumer population, life insurers have historically not focused on them due to low operating margins, difficulty in building scalable business models, and challenges with finding effective distribution channels. While much of this remains true today, the expansion of Tier 2 and Tier 3 cities and growing SME sectors promise a vast untapped potential for insurers. Hurun India again indicates that 56.4 million households are in the middle income segment, one of the fastest growing segments. Therefore, insurers can reconfigure their strategies to attract these low and middle income segments. In order to penetrate the rural market and achieve scale, insurers can move towards localizing distribution among and through community banks, microfinance, self-help groups, and affinity groups such as Mahila banks, while also introducing new, more targeted products to cater to rural needs, including social security insurance and hybrid microinsurance. The fifth point is the pension and annuity business. And this is expected to grow much faster rates. Again, Swiss Re report of 2021 says the number of old people aged 60 years and above is increasing globally. Of course, we all know that. And it is expected to double in 2050 due to improved quality of healthcare, innovation in stem cell therapy, genetic engineering breakthroughs, and accelerated use of technology in healthcare. Over 60 years will account for more than 20% of its population in 2040. However, the annuity protection gap again is very high, indicating that people are not going for an adequate level of annuity protection despite our economic growth. Swiss Re estimates that the retirement funding gap is projected to reach $85 trillion by 2050 at a CAGR of 10%. These structural growth drivers should ensure that the life insurance sector will continue to deliver over 15% total premium CAGR in the next 2 decades. The combination of brand and distribution reach, coupled with innovations in offerings, should help insurers continue to gain market share with better profitability, as the benefits of product mix would accelerate their growth further. We need to think of innovative distribution channels to reach this segment of unorganized people and bring them into the insurance safety net. We must build an exclusive pipeline and simplified annuity products to attract this segment. The government and the regulator have realized the challenges emerging from the rising mortality and longevity protection gap, and they have been very proactive in facilitating the growth of mortality insurance and retirement products. IRDAI has proposed a 30% compounded annual growth rate target in gross written premium over 5 years for top-tier insurers because of their large base. It has also suggested a 50% CAGR for smaller companies. The broader policy environment should continue to be in the same direction, and IRDAI should implement regulatory reforms such as sandbox, risk-based solvency framework, and IFRS in a measured manner to enhance the insurance penetration further. The fifth, of course, this is all something that you already know, the economic revival, which is happening even though the pandemic has slowed down. But the positive market outlook and economic growth, S&P has projected economic growth at 7.3% in 2023, and the increase in urbanization, industrial developments would pave the way for improved insurance penetration in the country. 7, and this is very important to all of us, is the faster digital adoption. The increasing digital penetration in the wake of the COVID-19 pandemic, as well as the resultant change in consumer behavior, is reshaping the insurance industry in India with digitally savvy customers looking for personalization and flexibility, among other facilities in their insurance business. Besides, a boom in the insurtech industry and an ecosystem push towards using new age technological tools like AI, big data, IoT, etc., is changing the way insurance has traditionally been provided in India. Therefore, it enables insurers to accelerate their digital journey, bringing a wide range of capabilities to the table, including risk-based underwriting, upskilling, tools and techniques, innovative product and pricing design, process automation, etc. 8th, this is again about customer, and therefore, when we move towards a customer-centric model, the pre-sales experience is something we still believe is in the nascent stages, despite insurers' efforts to provide product transparency. However, firms are actively streamlining their sales process with the help of technologies that we spoke of earlier, and these particularly, like Mr. Devesh also mentioned, facial recognition algorithms can facilitate KYC validation and to make near real-time underwriting and policy decisions. Most life insurers have accelerated their digital processes from computer-based underwriting to online services. 93% of new business applications are now initiated using digital platform, while a subsequent 69% of service transactions are processed through the web, SMS, and IVRS. 9th point in my speech is the creating customer trust. Again, insurance industry, I think this is a big challenge. Beyond technology, I think there is a need for insurance companies to work towards building greater customer interest and trust in the industry and improving access to insurance by rethinking various processes and rules, such as the GST rate of insurance products. Building customers' trust in the insurance industry and simplifying the whole claim settlement process, and the problem for the industry to solve is to make the process of claiming payments frictionless for customers. Today, I think this is possible. Last but not the least, is point number 10, which is changing distribution channel mix. At least for LIC, agency channel has still been the largest channel in life insurance. Some of the other insurers do have good agency channels. And this would continue to be the major channel in the coming years, as the Indian customers still need the intermediaries' help in buying insurance, as they are not confident about buying it on their own. The second largest channel after agency is bancassurance, which has become the primary avenue for consumers to discover and purchase life insurance, making up 55% of the distribution share in 2022. The success of the bancassurance channel is attributed to consumer trust, pre-existing relationships with banking institutions, and banks' in-depth knowledge of their customers' wealth, enabling them to provide products aligned with their customers' needs. Although the D2C distribution of life insurance is still in the nascent stage, against just 3% in India, it has been growing steadily, and online buying growth has increased after the pandemic. An ongoing pandemic has renewed interest in protection, driving a 40 to 50% increase in digital life insurance sales from pre-pandemic levels. Insurance customers on digital today enjoy better service due to end-to-end digital experiences that leverage technological applications, which in turn is expected to drive growth for the industry. So, ladies and gentlemen, as I said, these are the 10 points which are not new, but they need to be revisited, they need to be worked on time and again. And now there are challenges when looking to sell life insurance through digital channel, of course, but then we need to understand that the country is growing digitally. People are coming onto the platforms, people are becoming digital, and there's no reason why we can also make it happen. So I believe that to address this, insurers need to upgrade professional intermediaries, simplify their customers' onboarding experience, offer simple and standardized products. What is needed is a better way to communicate and ultimately establish the need for coverage. This needs to be done, as I said, to build trust. This is also critical for converting the prospects into satisfied, loyal customers. Thank you for your patient listening. Thank you very much. All the best to all of you. Thank you.
Thank you very much, Kumar sir, for the 10 important points which are very pertinent to today's topic.